Hey guys, V. Rigoni, Max, high performance real estate entrepreneur. So what we're talking here again is we're talking about where is this market going? Why do I say that? Well, the new numbers just came out. They came out on home sales from the National Association of Realtors, and they came out as being down 4.1% in sales. They can add that to all the other months they've been down for the most part, and things are slowing. Now, I always tell people, get out there and look at houses and see what's going on. Well, I've been doing the same damn thing. I've been out there looking at properties with the realtors. And what I'm seeing is longer times on the market, the longer time for sale on the market. That's extending. We're starting to see price reductions, even here in the Middle West, because I'm in more in the Chicago suburban area where things have been pretty tight. You know, they haven't gone down much. That's because they didn't go up like Florida did. They didn't go up like Tennessee did. They didn't go up like most of the rest of the world did. They kind of just went up on a much more muted basis. And so when things don't go up as high, they don't fall as fast or as hard. That's kind of what the Middle West has always been about. That's kind of what the Middle West has always been about. So what I'm saying to you is, just like I said in the last video, is know your market, right? But we're starting to see that. We're starting to see both on a national basis, but it's starting to also happen in most of the locales. Because remember, real estate is local, but the economy is national in most cases. Yeah, you can have some specific things going on in your world, like what was going on in Austin when half of the Silicon Valley wanted to move there in the last couple of years. But now we're starting to see some significant drops in pricing in those types of areas. So the areas that have gone up the most and the fastest are starting to come down faster, and they're coming down harder because, you know, when you got 8% mortgages, you got 7.5% mortgages, you start to price people out of the market, especially at the kind of prices these homes have reached, because these homes reach these prices based upon what? A 2.5% to 3.5% fixed rate mortgage. Once you apply a 7, the mortgage payment gets ridiculous, and people then say, hey, I can't afford it. Like 4.1% of the homes sales were down last month. That's why, because people said, hey, I can't afford it. Now, the crazy ass thing is, they surveyed some of these people, and they said, what are you going to do now? Well, we're going to use some of that money and go on vacation. The money that we're going to use for the down payment because they can't afford the house anymore. That's what I talked about when we were talking about instant gratification. It's amazing. You can't make this shit up, people. It's not that they're going to save more money. They're going to put their nest egg away and they're just keep adding to it as much as they can. At the same time, maybe keep improving their credit score so they can get a lower rate, as low as possible. No, they're figuring you go on vacation. God bless them. Maybe they go to more restaurants too, because, you know, we're involved in restaurants. We love that. In fact, they do, because according to the numbers, the consumer numbers in the last month, people spending money on vacations and on restaurants went up, whereas almost everything else went down. That's just the way the American people think today. They don't think about the future. They think about now. So you're different. You're thinking about the future. You're different. You're thinking about the future. You're thinking about, hey, how do I take advantage of what's coming? Because if home sales are down 4.1% and buyers are leaving the market, and homes are now going to be for sale for longer and longer periods of time, and there won't be as many 4 offers, 5 offers, multiple offers as there have been in most locales, there still will be some locales that will have, some metros that will have multiple offers where prices may not drop as much, but for the most part, we're starting to see it across the board. So then the time on the market starts to extend, right? All right, the home prices, they start adjusting them down. You start to see price cuts. You know, let me tell you, a real interesting story. I looked into this one house. We were looking for, we're always looking for a bargain. So we started looking at this house. This house was in Libertyville, Illinois. It's an area where the starter homes are about $350,000, $375,000. Well, one of these flipping companies, they bought one of these houses for a great price. I think they paid like $230,000, $240,000 for it. And what did they do? They bought this house, I think last July. They went in and, we were going to take a drive over, take a look at it. I'm really not up to paying something where someone went in there and redid that. I'm figuring they probably redid the whole house. They raised the price now to, I think, about $350,000. so it would match the market relative to the size and with all the new stuff they put into it. What do? So we pull up to the property. It looks like they did pretty much nothing on the outside. Not saying that the property needed anything on the outside, but, it's the same look it had for the last 20 years. Then we go inside. And I'm figuring it's probably got a new kitchen, right? I mean, hell, they took the price from $230 up to $350. And I'm figuring it's got to have a new kitchen. It's got to have new bathrooms, right? So what do? We walk in. They didn't do anything, much of anything. They painted the place. They painted all the trim, all the walls, all the ceilings. Got it all painted up real nice. Walk into the kitchen. It's got some new vinyl flooring that's fake-looking wood. It's not even clip-in flooring, which is fake vinyl as it is, but at least it clips in and it's real. This is just roll-it-out vinyl that looks supposed to look like wood. Then we look around. It's got the same old cabinets. It's got the same countertops. They just painted the place and put the floor down. Then they put in a new light fixture. So we walked through the whole place. This is what was going on. They just did change a little bit of the flooring in the rooms. They repainted it. The bathroom, they did nothing to except a new light fixture, and they left everything the same. Then you go downstairs, same thing. It was a finished basement. All they did was put new vinyl flooring down in the basement. That was it. Actually, it wasn't vinyl. It was kind of an indoor-outdoor carpet, which, in a basement, not so much, right? Because it holds the dampness, the moisture, whatever you get. My point is that back about a year and a half ago, they could have done that to this house. They could have done this, especially in this marketplace. That marketplace is a hell of a marketplace. It's one of the best places to live in Illinois. And so it had a big lot. Normally, they would have gone in there. They would have repainted the place. They had their system down. There's a big company that does this, big flipping company. Instead, they've been living with this property for months now. That's right. And now they're offering a special bonus, a reduction or credit, extra credit, whatever. My point is that a year and a half ago, they had to flip that thing for $350. They probably would have got more than that. They would have had about 5 offers. Well, that day is gone. That shit's over, man. They're stuck with this house now. Because it doesn't take much to look in there, walk around there, and as you know, these MLS sheets now, it's easy to find out what the person, when the last time it sold, as we call it in the industry, when the last time it traded, and at what price. And then you compare that to the work they did, and you're like, are these people nuts? But that's getting out there and finding out what's going on. That's what I always talk about. Get out there and find out for yourself. The market, the area in which you're going to be investing in, get out there and learn the market. That we talked about that. But that's what we see going on. When you compare that, all the houses that we looked at, people have gotten really used to just walking out of houses, not doing a damn thing, and getting multiple offers. Well, you could see they're still walking out of the house, not doing a damn thing, but they're not getting the offers. And the time on the market's extending. And then they're starting to do what? They're starting to cut the prices. So there will be some softness in prices as we go forward. You're going to be looking at that. Now, am I saying you're supposed to go out there and pull the trigger on a house? No, probably not. Unless there's some, big reason why you need to. If you're homeless or something, I don't know. But go rent. This is a great opportunity coming, folks. Great opportunity. Because if we go into 2024, okay, and everybody said, and I've been telling you this, everybody over some of these people, even from Bigger Pockets and some of these other places, a lot of these people were saying, hey, they're going to start cutting rates at the end of this year. Well, they're not. Now, it looks like they may have stopped raising them, but they're not cutting them. And it looks like if they're going to cut them in 2024, it's probably going to be the 3rd or 4th quarter of next year before they start to cut them. And we don't even know if they're totally done raising them. Because remember, inflation is still 100% above where they want it to be. The inflation is at 4% and they want it at 2%. So they're starting to see the numbers come in. Things are slowing down more and more and more. Looks like retail sales are going to be kind of a struggle. Look at Walmart. It's just, it just took a big hit. Lowe's just came out with their earnings, took a big hit. That's what's going on. And now, all the people that provide all the products, all the manufacturers, all those people that do the shipping, they're all been taking a big hit. Now, eventually, we're gonna end up in an actual recession. They're talking about a soft recession, soft landing, probably. And why is that? Because you got $6 to $7 trillion of money still sloshing around in the economy that was printed in the last 3 years. and you don't have enough workers because they told people it was good to go home from the pandemic and never come back again, because if you pay people to stay home, what the hell you think they're going to do? And then they're going to lose their desire to want to go back. And so they don't have enough workers. And so all these things are leading up to a situation. So now they've got a new term: higher for longer, higher interest rates for a longer period of time. Shit, I've been saying that since day one, because this is a different kind of an economy. Everybody's used to where they need to fix the economy. And so how they would always fix the economy for the last 40 years, since the end of the crisis of the recession of 1980s, is that they would cut interest rates and flood the economy with money. That's how they fixed every problem in the last 30 to 40 years. Well, you can't fix this problem this way. It's just the opposite. You got to create the problem. That's what they're doing. All right? Now, there'll be casualties. There's always casualties to these situations. People who overbought, people who do, there will be some people that will lose their jobs, unfortunately. This is not going to be where you're going to pick up a lot of properties in foreclosure unless you're dealing in commercial or dealing in apartments. And even then, there should still be enough of a market so that if the people need to sell because they screwed up, they can certainly cut the price and sell. And why is that? Because buyers can still get financing. Okay? They can still get financing. One of the reasons you had so much foreclosure in the '08 is because the banks shut down and they wouldn't give anybody any loans. So unless you had cash or a seller was selling with owner financing, nobody could buy. Well, that's not this time. This is a different situation, but it is still going to give you opportunities. Are they going to be the mass opportunities of 09, 10? No, they won't be, at least in residential. Because apartments and commercial are going down the same road. They went down the same road on some level as residential did back in 06, 07, and 08 to give you the housing crisis of that time. And why is that? Because, as I've said before, these are the people that went out. They got adjustable rate mortgages in order to make overpriced deals work. And if you bought one of those overpriced deals, or you were an investor into one of those overpriced deals with the wrong kind of mortgage financing, in other words, adjustable rate mortgages, you're screwed. You may have lost a lot of your equity, or you're going to lose your equity as the shit hits the fan, as they say. Now, also, in commercial, there's a certain number, there's a whole lot of billions of dollars worth of mortgages that come due this year that have to be refinanced. And these mortgages were taken out 10 years ago when the interest rates were still close at zero or close to zero, and the mortgages were 4 or 5% mortgages, and now they're going to get refinanced, into 10 on the commercial level, 9, 10, 11. That's going to create a lot of distress. And in that distress, in that disruption, there's going to be some huge opportunities. So let's be prepared. Now, you might say, Vic, how am I going to participate in a commercial property? Well, I don't know. Figure it out. Do some reading. Get some information. Follow this channel. Subscribe to this channel. You'll learn more. That's what we teach. It's going to take time. Remember to always say, one of my number one adages of real estate is it's slow to go up, it's slow to roll over, it's slow to go down, and then it takes time and the bottoming out and the process of going up slow again. This isn't like a stock where Tesla's up $50 today or down 75 tomorrow. That's one of the greatest things about real estate. That's one of the things that makes real estate so easy to deal with, because it's like a slow walking herd of buffalo. They're just meandering across the savannah. You know which way they're moving. It's not hard. Now, once in a while, a lion comes running up on them, and then they all scatter. I get it. But this is the way this is moving. Now, some of these people are going to be scattered on some of these apartment buildings that they overpaid for 2 years ago, and they put the wrong kind of financing on, or if they refinanced the property and they took out a 5% loan 5 years ago so they could pull out a lot of equity, and now they're over, their loan to value is going to be questionable. At the same time, their interest rate is going to double, and they're going to have issues. These are the opportunities we want to take advantage of. You can also take advantage of it through real estate syndications. They're out there. Look at them. They can be very good. You don't even have to get your hands dirty. But this is also going to be a market in which you can get your hands dirty, where there's going to be opportunities. Why? Because the banks will be willing to finance this time. Now, that can change. There is one cloud over the banks, and we all know that. It's the commercial loans. It's the treasury bonds that they got in trouble with when they took short-term deposits and bought longer-term treasury bonds. And now the valuations of those bonds are in the toilet, and they hold them on as assets on their banks, on their bank deposits. And also there's a new rule now where they're coming out where the banks have to hold higher levels of cash. Okay, the banks are fighting it because they know they're already in trouble 101. Right? And so there's some things out there, yes, that could change the way things look in 5, 6, 8 months. But barring some disaster in the banking industry, they're much more willing to lend. Now, are they happy to lend right now? Not so much, especially on commercial. But they'll lend on residential. So if you see some opportunities, we always have to be looking. Where is the opportunity? Where should I be looking? What's opening up? What is closing? What's opening up? For us, when we saw apartment buildings starting to close, where people were overpaying for them and you have to get stupid loans, bridge loans and interest only, which sometimes it's really not so bad, but adjustable rate mortgages. They're buying this stuff with adjustable rate mortgages when interest rates when the Fed fund rate is basically zero. That's a disaster waiting to happen. But they didn't care. They just got caught up in the greed. It comes down to greed, people. Now, if they lose these properties, that's on them. No one told them to go out and buy a property and pay too much for it. No one told them to go out and get an adjustable rate mortgage when the Fed fund rate was at zero. My God, use your head. But you see, they have no wisdom because they never lived through this before. They just didn't. Once you live through a problem, and they say, it's like I've said before, wisdom comes from memory. Once you have a memory of what you lived through before, under certain circumstances. Now, I guess, like they say, history doesn't necessarily repeat itself, but it does rhyme. Well, shit's rhyming right now, people. Now, what's the other thing that's going to be different as we go forward? Is the recovery. Once we get into recovery, it may be a little bit more different than it was back in 1982, 83, 84. When the market started to recover in 84, 83, 84, 85, what did you have then? Well, you had a more conservative population, right? You had different pressures around that economy. You had less people working. In other words, you had less two-family incomes. You didn't have 401k plans where you could pull money out to go put down as a down payment. All right, none of that existed. So when that economy, plus you had a Paul Volcker who, when he killed the economy, and I mean he killed it, by raising those interest rates and keeping them there, that the inflation in real estate did not come back in most of the country. Yes, in Silicon Valley it always bounces back, in the San Francisco area, in Manhattan, it all bounced back at the time. Well, we know how different those markets are now. Just the opposite, right? In a lot of ways. But I digress. So what you're going to see here is that when they killed that economy, you had 2-3% inflation rate on homes for the next 10, 15 years. It never came back to the way it was during the 70s and 80s because you didn't have the basic inflation in the economy anymore. They really did chop it down. They burned that forest down. Now, this time, even if they burn the forest down, meaning the economy, and they get it down to that 2%, well, what you got going on now is different. You have a bigger growing population than you did then. All right? More people work, more couples work, more partners work. There are more two-income families. Number 2. Number 3, you're going to have people that have money that they can pull out of a 401k plan. They can do these things. These are the things that make a big difference as you go forward, right? And so, and then one of the biggest things is there's not enough houses. Back in the 80s, people were building houses like crazy, all right, because of the baby boomers. Right now, because of the crisis of the economic crisis of 08, 09, you then had, after that crisis went through, the only people that were really out there buying a lot of houses were corporations. You know, the Blackstones, the BlackRocks, all those kind of people. Do you know that they own 25% of the housing, single family and multifamily housing in this country? You know, small duplexes, things like that. They own 25% of it. That wasn't that way back in the 80s. They may have owned 1 or 2%. They own 25%. They own 1 out of every 4 houses in America is owned by a corporation used as a rental. So what I'm trying to say is there's such a restriction of the housing stock, such a huge restriction, that when this recovery does happen, then you may see more greater levels of inflation come back into the market, into real estate. Once again, because of the demand and ability to borrow money and have the money for the down payments and have the incomes to qualify that they did not have back in the 80s. So be ready, get ready. Think about what's going to happen here. And you want to get rich, you want to start to move down the road of being financially free, then start moving forward on learning more, getting out there, seeing the properties, see the prices as they start to drop, learn how properties in your area are staying on the market and how that's impacting the price. It all comes down to price, right? Everything. If the driveway's bad, it's the price. Okay, I don't care what driveway. Driveway in a commercial building, driveway in you're going up to your house. Well, then it affects price. If there's a structural problem, it affects price. Everything comes down to price. Time on market affects price. Availability of mortgages affect price. Interest rates of mortgages affect price. So know what price is. Understand valuations in your marketplace. Let's get out there, because we're going to see some opportunities coming up. Now, are they tomorrow? Most likely not. And once again, I always say, if you're out there and you see something that's down 40%, well, hey, that may be the great opportunity you're looking for. Someone might just want to dump something. This is a great time in which to go around and start putting in some really low ball, embarrassing offers. Put something in there that's down 15, 20%. What are they going to tell you? No. The real estate agent has to present it. They may not like you, but you go present 20 offers, 40 offers, 50 offers, down 20, 25, 30, 40%, and it's a high, I can't guarantee it, but it's an extraordinary likelihood that just according to the numbers, someone was just telling me losing weight is all about the numbers. Well, according to the numbers, you put in enough offers down 30, 40%, someone's going to say what? I need to get rid of it. So there always can be an opportunity. It doesn't matter how much work you want to put in for that opportunity. Let's get out there, guys. Let's make it happen, right? And what do I say? All right, think big, start now, grow fast. Hey, V. Rigoni, Max, high performance real estate entrepreneur. Let's make it happen.